Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice.
My name is Stuart Watson, and I'm standing in for Jonathan this week to cover the news roundup while he is away on holiday. Jonathan has pre-recorded an interview with Dean Buckley and Andrew Ross, who are the chairmen of Alliance Trust and Witan, respectively. These are the two large global trusts which are currently looking to merge. That interview will be coming up shortly. The week began with the news of Joe Biden's decision not to run again in the upcoming US presidential election. Markets didn't move materially on this development, which wasn't entirely unexpected, but they did fall heavily on Wednesday after disappointing results from Tesla and Alphabet, the owner of Google. US markets fell around 2% over the first 4 days of the week. However, the FTSE All-Share, with its minimal tech exposure, was up nearly 1% for the week as of Friday morning when I'm recording this. The Investment Trust Index was down around 1.5% from Monday through to Thursday. Looking ahead to next week, we have results from more of the Magnificent Seven. We have Microsoft, Apple, Meta and Amazon. And we also have the latest interest rate decisions from the US Federal Reserve next Wednesday and the Bank of England on Thursday. Turning now to the investment trust sector, and we had a few more results this past week, although most of them were half-year numbers. Taylor Maritime, the younger of the two shipping trusts, released its results for the year to the 31st of March. These showed a minus 9% total return due to a decrease in the valuation of its shipping fleet. Taylor Maritime has sold some of its older vessels, reducing the size of its fleet from 51 to 39, and use the proceeds to reduce its debts. MyGo Opportunities, which invests in other close-ended vehicles, produced an 11.3% return for the year to the 30th of April. That compared to 6.9% for its benchmark, which is SONIA plus 2 percentage points. MyGo is also planning to pay a dividend, which will only be its third dividend since it was launched 20 years ago. Invesco Asia was another trust with full year results to the 30th of April. It returned 2.7% compared to 7.9% for its benchmark, and it put the difference down to stock selection within China and being underweight towards the Indian market. We also had interim figures from BlackRock Thornton in the UK smaller company sector that returned 19.2% over the 6 months to the 31st of May, and Herald, the technology trust, which was up 11.4% for the 6 months to the 30th of June. Both of these companies managed to beat their respective benchmarks. Laudaventure in the UK equity income sector returned 9.7% for the first half of 2024, while Alliance Trust produced a 9.5% gain. That meant Laudaventure was a little ahead of its benchmark, which is the All-Share, while Alliance slightly lagged its global benchmark. Away from results, I'll just highlight a few other announcements of note. Finsbury Growth and Income is asking shareholders to renew its authority to repurchase its shares. This was last renewed at the Trust's AGM in January of this year, since when it has spent $175 million on buybacks. JP Morgan European Discovery has published a circular setting out more details of its tender offer for up to 15% of its shares. This offer will be at a 2% discount to NAV and take place in September. Bluefield Solar Income has sold a 50% stake in 9 of its solar assets to GLIL Infrastructure, and that's at their latest carrying value. Most of the proceeds will be used to reduce Bluefield's borrowings, with the remainder funding the development of some new assets. Both Baillie Gifford Japan and AVI Global have taken advantage of the low interest rates in Japan to take out some long-term fixed-rate debts. Baillie Gifford Japan is paying 2.05% for 12 billion yen, that's about £60 million, while AVI Global is paying 2.28% for 5 billion yen, that's £25 million. Bill Ackman's Pershing Square, that was a notable faller this week, and that was after shares of Universal Music dropped by nearly a quarter on Thursday. Pershing Square doesn't publish regular fact sheets, but we do know it had 25% of its net assets in Universal Music at the end of 2023, and it has a sizable position in Alphabet as well. Our profile this week in our subscription service, the Moneymakers Circle, is Henderson European. This is a £700 million trust that was formed by the recent merger of Henderson European Focus and Henderson Euro Trust. It plans to hold a concentrated portfolio of around 40 companies that it dubs Europe's Global Champions. Now over to Jonathan and his interview with the chairman of Alliance Trust and Witan.
Before setting off on holiday this week, I had the chance to sit down and discuss the recent merger between Alliance Trust and Witan with their two respective chairmen. They being Dean Buckley, the chairman of Alliance, and Andrew Ross, the chairman of Witan. Both trusts pursue a multi-manager approach, and at the end of last month, they announced that they were proposing a merger that will create a £5 billion market cap vehicle in the global equity investment trust sector, which is the biggest combination of two trusts that we have ever seen in the investment trust universe, a sign also of the prevailing trend of consolidation in the sector. I thought I'd start with this question to you, Andrew, as chairman of Witan. You've been on the board there since 2019, and I think it's probably fair to say it's been an underwhelming period for performance of the trust. But can you just explain how you came to make the decision to essentially do your strategic review, which has led to the deal with Alliance that we're going to be discussing?
When Andrew Bell notified me of his intention to retire, we decided that rather than just go for a sort of like-for-like replacement, this was a good opportunity to sort of take a bit of a step back and really go through all the options that might be available to us. We've been taking an approach to multi-manager for about 2 decades. We were quite early in that process. I think at the time that we adopted it, it was unusual. And as you said, it hasn't worked so well for us recently, but it's certainly worked very well for us over the 10 and 20-year periods for our shareholders. But 20 years is a long time to just continue doing the same thing. So we thought we would take this as an opportunity to step back and say, what is the best thing that we can do for our shareholders over the coming decades? And so we worked with JP Morgan Cazenove, our advisors, who helped us run a really comprehensive process, which we triggered in March of this year by announcing our intention to put the management of our assets out to tender. And we were very unprescriptive in what we asked people to do for that. We thought we would see as many interesting and different ideas as we possibly could. That produced about 50 different applicants. With the help of JP Morgan Cazenove, we whittled that down to a second round of 10, put them through a series of hoops, and got to a final 5, all first-line institutions, all taking contrasting approaches to each other. And we had a very interesting day. We saw some really good presentations from all these organisations, but ultimately the board was unanimous that Alliance Trust was the route that we wanted to pursue. And I think there are 2 main reasons for that. One is it is continuity for our shareholders. As I've said, we've done multi-manager for a long time. I continue to think that accessing best of breed managers globally for a retail investor, particularly an unsophisticated retail investor, is a very good way to manage a trust. And amongst the propositions we saw some really powerful single manager propositions. But I think on top of the point of continuity, we were also very keen to avoid the threat that always exists in these points of joining somebody's investment management performance at precisely the wrong moment in the cycle of their investment performance. So those 2 things were the main things that led us, I think, in the direction of Alliance. We were also extremely impressed with Craig Baker and his team's approach. And I think I'll leave Dean to talk about this in more detail. It's a very interesting approach, and it's not easily replicable by other investors.
Indeed, I think that's certainly the case. So coming on to you then, Dean, Alliance had its own moment of strategic adjustment, shall we say, 7 years ago, and it's worked out very well as of today. It's been very successful. You have delivered outperformance, and the approach is, as you say, is something that is a professional approach that can't be easily replicated by private investors. For you then, what were the factors that weighed up in your mind? You wanted to grow the size of the trust, or you just felt that this was an opportunity too good to be missed?
Well, I think probably both of those, actually. We have a very similar strategy to Witan. We were broadly occupying the same space, this global equity multi-manager proposition. It's a core portfolio proposition, and we marketed the proposition very similarly. It's a sort of one-stop shop concept where arguably it gives an investor everything they would need from a diversified exposure to global equities. So from our perspective, the combination made a lot of sense. And as Andrew has said, it also provided continuity to both sets of shareholders. The merged entity will have a much higher profile. We're hopeful that it will be FTSE 100, much higher profile for the company, better liquidity. Many investors are demanding more liquidity, so I think it will give us access to a deeper pool of investors. We'll be able to focus the combined marketing budget on supporting one brand and one marketing strategy. I think that will give us greater traction. And economies of scale will drive further cost reductions. Our OCR will come down below 60. We think it'll be about 59. Our annual management charge to WTW and the stock pickers will be about 50 basis points. We think that's very competitive for a multi-manager proposition, and we understand that the costs of propositions are very important to investors. We also negotiated with WTW a significant contribution from them to the deal, which meant that there would be no NAV dilution for Alliance Trust shareholders. So when we discussed it as a board, there was no obvious downside for Alliance Trust shareholders. And in the view of the board, there was enough upside to make this a compelling deal for our shareholders.
Obviously, you've emphasised the point about the ability to market this trust more widely, and you have done a professional job there in the last few years. But is there a kind of implication there that you think you could perhaps bring the discount in and maybe eventually trade at a premium again? Is that something that would be part of your thinking? Why is marketing so important, if you like?
Absolutely. That is our ambition. As a board, we are focused on delivering the best investment performance that we can in an area where we think there is significant demand from investors, particularly retail investors. So we think it's a reasonable aspiration to have. Our discount as being quite stable. We've generally traded on a much narrower discount than many of our competitors. And at the time that we were putting this deal together, our discount was about 2% to NAV. We've drifted out a little bit now, 4 or 5%, but generally quite close to NAV. Yeah, so that is our aspiration.
And just before I come back to Andrew, it's always seemed to me that one of the challenges for the investment trust, particularly the global generalists, is they do face competition from passive funds, very much so. If you are an active manager, and it's been a very tough period for active managers over the last 5 years, you've really got to be able to demonstrate that as an investment trust, you can deliver performance at least as good with at least not too excessive volatility. Would you agree with that? That's why it's so important to have the ability to trade close to par.
I do agree, and I do see passive funds as a significant threat. That's one of the reasons that I'm very keen to ensure that our OCR is competitive and the gap between passive fund and our OCR is as narrow as we can possibly get it. And then we can rely on our stock pickers to deliver outperformance over the long term, which they've demonstrated that they can do.
So, Andrew, if I come back to you, just picking up on that point a little, Witan has always made the case in the past that it has a distinctive approach. It's offering something different to shareholders than just buying a passive fund. Do you think that your experience over the last 5 years that led up to this deal has underlined the difficulties of actually delivering that in a volatile world?
Well, the straight answer to that is yes. But actually, if you dig under the surface of what has gone on at Witan in the last 5 years, and we basically had a torrid few months over COVID and the sort of ins and outs, the gyrations of markets around COVID. which took us from being pretty competitive with our benchmark to way below it in literally a matter of months. And in the ensuing period, we've spent our time gradually clawing that back. I think the other thing I'd say is there's obviously things within Witan, like our investment trust portfolio, which, our investment trust portfolio has gone from being the strongest part of what we do for investors to the weakest part, principally because of the discounts that have emerged in the sector, which I clearly don't need to tell you about. So I think that although we've done a very good job for our investors over the long term, it's been more torrid recently, as you said, and we've been recovering from that gently, not perhaps as adroitly as Alliance have over the last couple of years or so. I think the other thing is that the combined portfolio or the combined trust will sit really neatly. People will use passive, and they should use passive for part of their investments. This is a very logical next step for investors to sit alongside a passive portfolio, quite frankly, because as Dean has described, the fees are actually not very much higher than the kind of passive funds that a retail investor can leverage. You could argue that they're actually less concentrated and conceivably less risky at the moment because of what's gone on with the Magnificent Seven. Passive funds are the only funds that are fully weighted in the Magnificent Seven because they're the only ones that are allowed to be. Well, it may have no risk against an index, but in the absolute world of real money, there is significant risk. And so I think we're a pretty good hedge to hold alongside that.
Yes. A global passive fund has a bigger weighting today in NVIDIA than it does in either the UK, French or German stock markets.
Yeah, and that goes against our common sense, if nothing else. Let's put it that way. That seems unlikely to be sustainable for a long time. So coming back to this issue then of what's going to happen when the two are combined, it's going to be managed entirely in the Alliance way, as it were. So that means you're going to get rid of the investment trust holdings, presumably, unless they happen to be in the portfolio already through one of your managers. How is that going to play out, do you think? Is there a danger we're going to lose some money on those trades as you unwind them and so on?
No, they're high quality assets and they represent a very small percentage of the combined portfolio. So we have no time frame for divestment. There is no urgency around doing it. We've held illiquids before. We're comfortable holding them. We've got the expertise. We understand what they are. We've got the expertise to manage them. And WTW will manage those illiquids in the best interests of our shareholders. So there really is no urgency around selling them.
Right, and I guess, Andrew, you were going to say that they could well actually produce some outperformance themselves over the next few months if derating continues.
Well, I would like to think that that is the case, yes. The point I was actually going to make is that, I've put together investment management businesses on a number of occasions, and these very often go wrong when somebody fudges the investment process. And that is why our board were absolutely happy to move sort of lock, stock and barrel to Alliance's investment process, because we then don't have to worry that we're combining two different investment processes and ending up creating something that is neither fish nor fowl.
Okay, so coming back to you again, Dean, we talked about the threat from passives, and you say the costs are nearly competitive, but you've still got a target of outperforming over a 5-year period. That's still quite a stiff target to meet, isn't it?
Yeah, and that's an aspirational target. I think history will show that managers that do that are amongst the very best in the industry. So it is a tough target. It's something that WTW have demonstrated that they can do over the very long term, because the strategy that we have with WTW, they've managed for many years. So they began with us in 2017, but that strategy was established way before then. And over the long term, they have delivered 2% above the index.
Right, and so, Dean, you're going to be the chairman and Andrew's going to be the deputy chairman. In terms of managing the combined trust, you say you have aspirations to get into the FTSE 100. On size alone, you'd obviously get there. So when it comes to the combined trust, what are you going to do about discount control and about gearing, the two things that are always said to be the great advantages of investment trusts, apart from their structure? What are you thinking about how that might play out over the next few years?
Well, we discussed discounts a little bit earlier, but, aspirationally, we would like to trade at a premium. But we're also very focused on the stability of the discount. We don't like to see volatility in our discount. So the board is not afraid to buy stock back when the discount widens. And I think you've seen over the past few years, as I said earlier, that our discount has been relatively stable. And that has been a function of pretty good demand for our shares on the back of strong performance, but also a board that's been prepared to step in and buy stock when our discount drifts out towards the 5-6% level. And I think you'll see a continuation of that. From a gearing perspective, we have a sort of strategic gearing of around 10%, and WTW manage that for us in a sort of a broad range of 7 to 13. They're towards the bottom end of that range at the moment, reflecting some short-term caution around markets.
And Andrew, if I can ask you this, you obviously have been active buying back your shares as well over the last couple of years. I think you bought back something like 8.9% in the last 12-month period. So you're a believer in using a fairly firm discount control policy, would that be right? Did you have a discount target or not?
No, well, we don't have a formal discount mechanism, but it's not just a discount. The reason we buy it in stock isn't just a matter of controlling the discount. There's two other impacts. One is it ensures liquidity. And if people are trying to trade above the market size, we're able to help shareholders with that. And the second point, actually, is for long-term shareholders, it's very accretive. The addition to net asset value by our share buy-ins last year was more than the equivalent of the fees that shareholders paid for managing the trust. So that's a pretty good reason for buying in shares as well, I think.
So we've mentioned, obviously, it's been a very tricky period for the last 5 years. You're going to have liquidity, you're going to have size. There's been a lot of conversation about investment trusts, about the need for liquidity and about the issues that have driven many investment trusts to a discount. These are two trusts that have been going for over 100 years, nearly 150 in Alliance's case. What's your feeling about the investment trust sector? How well is it coping with the pressures that it's been under in the last few years, given liquidity and consolidation in the wealth management sector and so on? I'll start with you, Dean.
Well, I think the sector does face significant headwinds. You've mentioned the wealth industry there that's been traditionally a big supporter of investment companies. But we're seeing consolidation in that industry, leading to larger companies, more clients, more funds under management, requiring greater liquidity for the investments that they use. They're also centralising their investment processes and moving to model portfolios and portfolio management services. And at the same time, they've got significant fee pressure. So I still expect to see strong support from the wealth sector for investment companies. There's certainly more headwinds around that than perhaps in the past. Over the past decade or so, there's been very strong growth in retail demand for investment companies. And I think near term, some of that's been challenged. Obviously, we've got a cost of living crisis and there's probably less saving. And at the same time, we've got much more competition from short-term interest rates and fixed income. So the demand environment for investment companies has been quite challenged. And I guess that's the reason why discounts have gone out as wide as they have and have stayed wide. It's this sort of imbalance, if you like, between supply and demand. Now, I think some of that is cyclical and will reverse. And I think that as and when interest rates fall, I think that might help discounts narrow a little bit. But I think also there is part of it that is structural and that there is some structural oversupply of investment companies. So consolidation, I think, is, of a highly fragmented sector. It's already started, and I think it'll continue. I think the key questions for boards are, is your strategy relevant to today's needs of investors? Is your performance long-term compelling? And do you have the scale that your investors require? And I'm not saying that small investment companies can't survive. I think they can, but they need relevance and or investment performance if they are going to survive. But I think we will see continued consolidation. We'll see some supply come out of the market. And when demand improves, which I think it will, that demand supply will find a better balance and discounts will narrow.
What's your reflections on that, Andrew, if I may ask? I might also throw in, since you do have this investment trust portfolio, it's not the huge part of your portfolio, but this whole issue around cost disclosure and so on, whether that's made life a little harder, certainly for some of the alternatives, which I think is what you use investment trust mainly for.
Yeah. So I agree with what Dean's been saying about the sector then. I mean, I think we do need to take a bit of a step back here. I mean, this is about once a decade, the investment trust sector goes out to wide discounts, and the reasons for it are different. But certainly we're all old enough to remember when investment trusts were principally held by institutions, and we saw a huge migration from institutions to wealth managers. We appear to be observing another migration at the moment from wealth managers to direct retail. Although it's quite interesting to note that there's one or two wealth managers who are actually now recommending building portfolios of investment trusts for their clients. And this goes against the sort of main flow that Dean has talked about, because they can see there's value there. And ultimately, that's what investors want. They want to buy things that are good value and see that value realized over a period of time. So I completely subscribe to the idea that the sector needs to make itself relevant, execute well, and communicate well. Tell people what you're doing. I agree with Dean that there will be some consolidation. Consolidation is easier in some parts of the market than others, of course. So when we put the assets of Witan alongside the assets of Alliance, 99% of them are highly liquid, very easy to value. So when you put the two together, there's not much room for debate, as it were. That would not be true if you were trying to combine two investment trusts whose underlying assets were private assets. That would be more complicated. To your final point, some change of regulations involving removal of PRIPs or things like that. Basically, the regulator has taken far too long to address this, and it should be addressed absolutely as soon as possible. Rachel Reeves has got a pretty much free hit in making herself look more market friendly than previous government has been. And this would be an important part of that. Clearly, investment trusts represent a very significant chunk of the UK market, and a change of disclosure regulations would help that a lot.
Before we go any further, I'd also like to one follow up on that, Andrew, if I might. You've had a benchmark which has been 85% world and 15% UK. And obviously, being 50% UK is, as it turned out, quite a big bet against the world index at the moment, because the UK is such a small part of it now. And also the fact that pension funds are going increasingly out of UK equities. Do you think that was a mistake to have that 15% benchmark? And or do you think that the tide will actually turn to bring the UK back into favour on a global perspective as a market?
On the first point, that UK weighting is down from 30 or 40%. So it's been a transition for us. If we made a mistake, it was not to be more aggressive on that transition. We've always intended to end up at 100% global, but we've waited for the UK market to give us an opportunity to execute that to the benefit of our shareholders. But as you quite rightly said, we've been pretty short of opportunities to sell the UK market at a good level and switch into a completely global index. So I think that's the background to that. Interestingly, actually, the one remaining UK manager that we've had in the portfolio, Artemis, has done very well for us. So we've not suffered from that. And our UK weighting has remained high because one or two of our global managers see the value in the UK market that you've talked about and have overweight positions in the UK. Will it turn around? Well, we certainly hope so. The UK market is not as cheap as people think it is, by dint of the fact that we've got some rather boring sectors and a lot of boring sectors in the UK market. And secondly, we lack, one of the things that's a sadness is there's some very good early stage technology in the UK, but it tends to end up seeing the light of day in private equity or in the US rather than the UK market. So that is a sadness. And if we could address things like that and make our market more relevant and more interesting. And this is a completely virtuous circle. Firstly, you have to get more liquidity into the UK market to make companies want to be quoted here. And the government can start that. I mean, the British ISA was a sort of poo stick in a torrent flowing away from the UK, wasn't it? Let's make that more significant. Let's make that £100,000 of people's ISAs going into the UK. Let's try and reverse the pension fund position that you've talked about, the de-risking of investment generally. I think both pension funds and regulators see their job as to de-risk, not manage risk, which has been entirely to the detriment of savers. Now, Rachel Reeves has talked about trying to get pension funds to reinvest in the UK. It's not a particularly clear path, but I think it's an extremely worthy path for her to walk and could be quite transformational for our market. And the final thing I'd say on the UK is, I've said throughout this period that the only people who tell us how cheap the UK market is are already in it. And what we need to see is people who aren't in the UK market deciding it's cheap and coming into it. And I have seen the first straws in the wind there of overseas investors asking for proposals from UK-based managers to put money into the UK.
Dean, what are your thoughts on that issue? You will continue to be running a global mandate, and the UK is just a tiny pimple on the horizon, as it were.
Scarily small.
Scarily small, indeed.
I think it's 3% of our benchmark. Interestingly, we've got 5% of our portfolio in the UK. I'm not sure what that is telling us, but I do sense, talking to our managers, that there is more interest in the UK. And I do sense there's a sort of a turning of the tide. There's been literally no international interest in the UK for several years. There have been, as you said, massive outflows from DB pension funds for the last 20 to 30 years. They've got so little in UK equities now, one has to think that must be close to the bottom of their exposure. And retail outflows from the UK have been enormous. The data actually is quite shocking in terms of how much money has come out from retail investors over the past 2 to 3 years. So I'm beginning to think that we are at the worst point for the UK equity market. And certainly in the first half of the year, generally corporate earnings has done quite well. Companies have generally surprised on the upside. There's been quite a bit of corporate activity, private equity sniffing around. And I think valuations do look quite cheap in the UK. I know somewhere else where I'm involved, we've done some analysis on a like-for-like basis, sector for sector. And I think it does demonstrate that valuations are cheap. So I think that the UK market could do quite well from here.
It's started to do so already, actually.
Yeah.
The UK market has done well so far this year, and some investors in the UK have done really well.
Yeah, it has started. That's absolutely fair. And let's hope it continues. I guess it is a difficult argument, isn't it? Because on the one hand, you'd say, well, looking back with hindsight, investors who fled the UK have actually done much better because of the dominance of the US market. But at some point, that, as you say, becomes counterproductive and you need to go into reverse. So let me finally then ask you about dividends. We all know that dividends are important to investors, and we all know that the AIC has all these dividend heroes. You've both been dividend heroes, which means you've continuously increased your dividend every year for the last... You come out your 50th year, I think, Andrew, and you're on 57 or 58 now, Dean, at Alliance. That's obviously a very impressive track record. But I think in your case, Andrew, your dividend hasn't been covered for a while. Obviously, you'll want to keep that status. But do you actually think it's a bit of a burden on your back, shall we say, to have this commitment or not?
Well, it was one of the things that we were very keen to preserve through this transaction, and the way that Alliance have structured the 2 dividends in the second part of this year will achieve that. And a very nice increase in dividend to existing Alliance shareholders as well. So one of the problems of running a large trust where well in excess of 60% of our shareholders are direct retail shareholders is you don't have a very clear brief with exactly what all your shareholders want to do, and they probably wouldn't agree even if you asked them to. So our take on this is that there are enough shareholders who like to see their dividends going up every year that we should be prepared to continue doing that. I don't think it's a particular burden on us. Obviously, what happened to dividends, A, over COVID, and B, as we moved our portfolio from the UK to be more international, means that we've had to use some reserves in order to smooth the progress of dividends. But those reserves belong to shareholders. So there's no burden on us in choosing to use some of those reserves in order to ensure a progressive dividend policy.
Just to back up what Andrew just said there, when I talk to retail shareholders, which I try and do as often as I can, this is the area where I get the most diverse feedback. And I can literally meet a retail shareholder who will tell me that actually, frankly, they'd rather we didn't pay any dividend and reinvested in the market because they're investing in Alliance Trust for growth, and that's what they want to see. And then my next conversation with a different shareholder, they'll say that income's very important to them, and they use Alliance Trust along with their other investments to fund their retirement. So you can't please all of your shareholders all of the time. But also going back to a conversation that we had earlier around passives and the threat from passives, I'm keen that our dividend is at a slight premium to what one might get from a passive investment. So we try to pitch our dividend around that level, which is just at a premium to the index and a premium to what you'll get from a passive investment, so that if you are an investor who's looking for yield, you're more likely to come to us than a passive competitor.
Very good. Now, final point is this deal has been proposed, has to get shareholder approval. The share price movement suggests that it is going to get shareholder approval. I'm sure you did a lot of homework before you even finalised the terms of the proposal. How did you arrive at the figure of 17.5% for the option for those who want to take cash? What was your thinking behind that? And how much of your shareholders do you expect to take that up?
Well, ultimately, it's a judgment call. We felt very, very strongly that we needed to offer Witan shareholders a cash exit, because even though the strategy is quite similar, it's not exactly the same. And we're now asking Witan shareholders to support a slightly different strategy. So we thought that it was important that we offered a cash exit. But we needed to make the deal work. We needed to make the arithmetic of the deal work so that it made sense financially. And ultimately, it was a balance of those two things. And the number we got to was 17.5%. And I think 17.5% is not massively out of kilter with the market norm in this sort of situation. Whether it gets taken up in full, I don't know. I guess based on history, my suspicion is that it will be taken up in full. But as Andrew said, Witan's got a very strong retail shareholder base who've been very supportive to Witan. So I don't know. I don't think there'll be a sort of overwhelming clamour to exit, but I suspect that 17.5 might get hit.
It's quite hard to answer your question, Jonathan, well, on how it's going to get taken up, because on the one side, as Dean said, we've got a shareholder register that's not full of discount players who have bought us on a sort of 15% discount and are trying to trade it into 2.5% discount. Secondly, of course, the discount of both trusts, well, Alliance has always been tight, but the Witan discount has moved in quite a lot during this process. So when the discount was sort of 7 or 8%, you might have looked at 2.5% and said, well, I'll have that. But if the discount's down to 4%, that's much more of a mute decision, isn't it? On the other hand, the share price is near all-time highs. Some people might take the view that capital gains tax regime will change under the new government. And we've obviously had some people, some of the wealth managers, as Dean has described, selling reasonably consistently. I mean, interestingly, our daily share buybacks are at the lowest level they've been for some time now. So it's very hard to call, but we're working on the assumption that quite a lot of it will be taken up.
Okay, and the deal is still on track. Quite remarkable to me if you can tie the whole thing up by the end of September or October, which is when I think you said it would be done.
Yes, we've got no information from our corporate brokers to suggest that that date is unachievable. So we're headed towards end of September, early October.
Obviously, both companies have to have a general meeting, and we're trying to hit that, as Dean said, either at the end of September or in the first week of October.
And finally, I can't let this moment pass without asking you just for a general comment on what's going on at the moment in terms of political uncertainty. We've seen this great drama of the US election. We've got the ongoing situation in Ukraine. I think you've both managed asset management firms that have global reach and so on. Do you think we're in a riskier environment than we have been for some time?
Yes, I'd probably put that the other way round, that we have got used to living in quite a low risk environment. I mean, if you go back through history, the sort of status quo that we've got at the moment is much more normal than the status quo that we've had for the last couple of decades. But it certainly feels a less safe and a less secure world at the moment than it has done recently.
Yeah, I have nothing to add to that really, but from an economic perspective, if we can get the balance between growth and inflation, if that balance can accommodate some interest rate reductions later in the year, then that could be quite supportive. But from our perspective at Alliance, the focus at Alliance is going to remain on this high conviction approach to stock picking based on the fundamentals of the individual businesses. And we think that's going to continue to add value for our shareholders over the long term. So whilst there may be some near-term volatility, we think long-term our approach will work well.
Well, on that note, that brings us a convenient moment to stop and say thank you both for taking part in this conversation. I've been talking to Dean Buckley, the chairman of the Alliance Trust, and also to Andrew Ross, the chairman of Witan. Those two trusts are about to merge to create a new combined vehicle, the biggest combination we've ever yet seen in the investment trust world. So let's all hope that it sails off into the future with great confidence.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.